Use code JACK250 to get $250 off to the Blockworks Digital Asset Summit. It's in New York in September, and ticket prices are only going up. Link is in the description.
So the bond market is saying it's a policy error. You're bringing on a recession. Asset prices are going to fall to a level where you capitulate and you do what you always do. The big thing about here and now is hedge fund managers are no longer pirates. They're no longer wealth preservers. They're kind of in it for themselves. It's heads I win, tails I win. You remind me who you are again. And so these characters find themselves, a lot of them find themselves in the Shark Tank. They're down 30%, okay? And they are hoping that the Federal Reserve reverts to norm and bails them out. So if you're down 30, the only road to redemption is to be very, very long. I think that could turn out to be a profound misstep because I don't trust this Federal Reserve.
So you think the Fed should pivot, but that they won't pivot?
I think they're clueless. I think that non-discretionary price items, i.e. commodities, will remain elevated. I think that will find, therefore, I think they will feel encouraged certainly by the politics. And again, like by covering their asses to keep on the offensive. I don't think the Federal Reserve has got no incentive to cut or walk away from its present rhetoric unless prices fall 25% from here. That's when they get called out. If the market takes, if we have a bear market and you're down like 45, 50%, it's all on the Fed. And do they crumble at that point? But where we are, we're at either side of a 20% correction. That's nothing. And that will not change the course of the Federal Reserve's desired direction. And I worry that I just worry that they're not as smart as the thousands of individual people that make up credit markets and treasury markets, and who seem to be voting with their reputations to say these steps seem to be the wrong steps. If you're 30% down in the tank, okay, what do? You buy everything and you bet that it's the same old Fed, and they'll recant, and we're going back to the moon. I'm not quite sure it's that easy. I'm not quite sure that the elevation in commodity prices will prove temporary. And so they've got to, if you will, treasuries have grown up problems. They may be a comfort blanket, but they've got grown up problems with the mortgage, with relationships. Basically, they've got grown up problems with a Fed that increasingly people just don't trust.
So you said that the treasury market is a comfort blanket for equities. Are you referring to the fact that the 30-year, the 10-year sells off, goes from 1% to 2%? Suddenly, the assets that we all know and love, Apple, Netflix, Facebook, they crash. Why is that the case?
Oh, that's a great question. Thank you for asking that. Ever since the great financial crisis, 2008, we've been operating in a depression, a mild depression, but a depression all the same. What is a depression? A depression is that despite the fact that nominal and real GDP are now above their pre-2007 levels, that the growth has been stuttering, and as such, we have never regained the 30-year trend in income and wealth that we were producing prior to the great financial crisis. So any rational person and trying to anticipate where global or US GDP would be in the year 2025 would be massively above where we're likely to end up. Yeah, that we have not regained the economic potential of our model, of our system. That is a depression. And as I go in and I define depression to the minute degree, I forget the question because I'm retired and I can't even remember my name, so I can't even remember the question. What was it again? Tell me, Jack.
Hugh, I was asking, how come it's the case that if the 10-year sells off, so the price goes down, the yield goes up, why is it that the equity prices crash? Because I get the theory, all right? I know the answer to the question I'm asking, but I'm asking for a much deeper answer than the answer that I know. So the answer is, oh, it's the discount rate, blah, 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 blah. But if you think that, money goes into asset A, you think it should come from asset B. So you think that they would sell off. Money goes out of bonds into stocks, out of stocks into bonds. But they've been selling off together. Why is that happening?
This time last year, asset values were 7 times GDP. We've never seen that level. Right? And the reason why is related to this question, and the reason why is related to the mild depression. We went into this environment with banks and the Eurodollar, this invisible system, which is becoming more and more relevant or more understood, having made a profound credit misallocation, which resulted in the near death of the US and indeed the global banking sector. In March of 2009, Citigroup traded at $9. That was the same as prevailed in the 1970s. And even 9 was overstated because Citigroup was bust. Okay. So the ensuing 15 years, banks are rueful of their policy errors. And they don't see opportunities. They see potential threats and further opportunities to mess up, if you will. And so the provision of credit has not been wonderful. If you are Johnson & Johnson, if you are Apple, if you're deemed to be a risk-free entity, they throw money at you. If you are a mom and pop enterprise in a cyclical commercial activity, yeah, not so interested. Even today, if you look at credit card balances, spending, credit card balances today are 9% where they were in 2019. Yes, we had COVID, but if you were to read the press, you would think, this V-shaped recovery, we've taken out everything else, but money is reluctant to be expanded by the private sector. So, and what do they favor? They favor the least risky assets because they don't want to go bankrupt again. And so when you reset interest rates to such very low levels, so again, March to 2020, as everyone knows, the 10-year bond yield was 47 basis points. And at 47 basis points, the value of what's deemed to be a commercially risk-free entity. What is a commercially risk-free entity? They don't exist, but the closest we get would be an Apple, let's say. Why do we say that? Because we brought this body-snatching invasion from God knows where called COVID, and their profits were fine. They were untouched. There were other businesses. Netflix seemed to be the same, except, well, we know what happened there. It was a function of people staying home. Apple wasn't. So Apple's the real deal, right. The closest we get to commercially low risk. So what happens next? It's unbounded. Literally, when rates are zero, the risk-free enterprise can trade at infinity. And infinity in our vernacular was Apple trading at $3.5 trillion US dollars. That narrative has slightly changed. We've repriced equities. So we do come back into your MPV thing. Despite that repricing, the banks are still very reluctant to change their asset policy. A bank should be thought of as a rudimentary hedge fund. It can do two things. It can invest in real assets, i.e. to lending to the real community, the private sector community, or it can lend to the government just by treasuries. Since for the last 15 years, at the margin is favored more and more and more treasuries. Even despite this backup in rates from 50 basis points, and I think we went about 325 basis points. I think today, where are we today? Like 260 or something. Banks are still favoring treasuries or treasury bills. They do not want price risk. And until we change that environment, I don't think actually, if we go on to I don't think we will see inflation. Inflation is a monetary phenomenon.
So would you say that the consumer price increases we've seen over the past year are not inflation?
Yeah, inflation is a monetary phenomenon. So we have seen we had the equivalent of a world war. You know, in the Second World War, we had to reconfigure and redirect industrial output to create weapons. This time around, we had to reconfigure global industrial capacity to do nothing. We sent people home. We shuttered. We closed it. And then the US, perhaps lacking some wisdom, sent a check to everyone and said, hey, spend, but sent a check at the point where still you couldn't go to a restaurant, still you couldn't go to a cinema. And so you went on Amazon, you went, hey, send me some piece of rubbish from the factory. But the factory's just, it's been idle for 18 months. They're just opening it up. There's cobwebs and they're like, oh, really? I'm like, that's a problem. Like I've got issues. So price has to respond. Price has to be higher to create the incentive for the entrepreneurs to do that, to come back on stream. At the same time, you've had this profound social tragedy of the environmental social governance that the many have been convinced that the climate has to be resolved, the global warming has to be resolved. Unfortunately, over the last 20, 25 years, the economics of the media have changed. Media assets are less valuable. If you're a journalist, you will have a podcast, you will be on a platform. God forbid you actually write for a newspaper, right? Because you get paid nothing, right? No foreign travel, nothing, right? So at the margin, the people who are writing are noble and wonderful spirits, but we're not seeing proper debate. And just like stock markets where we go bullish, bearish, investing is way more complex. The climate is way more complex. But unfortunately, we went to an environment where we went zero tolerance. We're not doing any more exploration. We're out of here. We're stopping the rot today. Okay, we're like Ayn Rand and Atlas Shrugged. We're going to put outside external directors and you know Wesley Mooch types, and they're going to tell you, no, you can't invest. No. We've got a Federal Reserve which every 3 or 4 years periodically is going to panic and raise interest rates and kill your credit rating just when they had told you should be investing. So those two things combined mean that for the average consumer, your spending is largely split into two camps. One, you've got no choice, right? One is filling the car up to go to the office. One is, the energy for heating the house in the winter or cooling it in the summer. And one is food for the family, right? Non-discretionary. Well, that's all the commodity complex. And those prices are elevated and those prices are remaining elevated. In Europe, given that Europe was at the forefront of the stupidity of that policy, and indeed Europe lost its sovereignty. Europe, as we're discovering, has no secure, permanent, low-cost resource base. How does that manifest itself today? We don't really use barrels of oil to heat houses in the modern economy. 90% of the feedstock is natural gas. If you were to put German household gas bills and you were to denominate it in barrels per oil, they're paying $600 per barrel of oil. I think the euro in that environment is going to trade at 80. They've lost sovereignty. It's not a nation state when you don't have that security. So the prices are presently elevated. Price increases and that rate of growth are running at 9-10%. Okay. My point to you is, however, if the elasticity of the money in circulating the economy. So I don't want to go back to the 1970s M2 plus CDs. Like trying to actually count every dollar doesn't work. Why does it not work? Because actually the Eurodollar system does it offshore and it does it in an invisible manner that you will never see. Okay. But again, I know.
And it doesn't include treasuries, right? So it's like M2, I don't know, does M2 include treasuries? Anytime there's QE M2 spikes, and anytime there's QT, M2 crashes. But that doesn't mean it's not. Yeah.
History reveals that you should never, if you find yourself talking about M2 plus CDs, like switch the channel, okay? But what I was saying to you is banks are profoundly conservative. Banks would rather lend to the US government in the very, very short duration that we call bills. They don't want risk.
Yes.
They certainly don't want risk in extending loans. And only when they extend loans do they provide the monetary mechanism to support higher prices. If you do not have credit growth running at least the same rate as price hikes, then consumers are forced with a choice. They have to retrench. Not all of them, okay? The media this week has been a joke. We had Walmart report its second consecutive quarterly profit warning. What Walmart is showing is actually at the margin, consumers have no choice but to retrench from discretionary spending because they need to fill their tank up with gas and heat their homes for the winter. That is the process, that is the evolution which prevents these high price increases in the basket of goods and services. It stops that becoming permanent because there's no risk appetite from the banking sector to provide the elasticity of money that would make it permanent.
Interesting. Hugh, what about the supply chain issues that you said? The cobwebs are still in the factory. There's no natural gas because 75% of Germany's imports came from Russia, and there's this huge energy crisis. Is the fact that people they're not buying a necklace for their dearest, is that slowdown in the economy a soft recession? Perhaps a deep recession. Will that be sufficient to slow inflation? Because the secular changes that you're talking about, whether it's reshoring, whether it's a war, whether it's energy underinvestment, are those things that really can be moderated in terms of consumer price declines by a slowdown in the economy?
I mean, first and foremost, I just have not known an inflationary period that existed with a conservative, risk-shy banking system, because unlike the Fed, the private banking system creates money, and it's lost its mojo, and that's a constraint for generating inflation or sustaining these high elevated price increases. Secondly, the benchmark was already set very high. The inflation that is infamous from history, from Germany, Weimar, to the republics in South America, they share a distinction, which is that the public credit markets were quite modest, whereas we live in a world where the bond market is enormous. And when you reprice it, when the private sector reprices yields higher, it has an immediate slowdown impact. So famously or otherwise, the taper tantrum of Bernanke and I want to say 2013, that pushed rates, 10-year rates almost doubled to about just over 3% when adult unemployment was 7.8. That was a tightening which was unwelcome and which immediately slowed the economy. And so the Fed never even got the opportunity to raise rates that it was flagging. So tail wags dog. There are, if you will, institutional fire breaks which make it profoundly difficult for agents of the government to create inflation. I mean, I would remind you that banks, public servants have been publicly pledging to create inflation for over 2 decades now, and they have consistently failed owing to
central banks.
Central banks, yeah. 2%, 2%. I mean, the Bank of Japan even had to lower its target to 1%, because of consistent failure. And then finally, there is a concern that the Fed has gone rogue. They keep talking about Paul Volcker. And that's a catastrophically suicidal reference point. Paul Volcker raised interest rates in the deepest post-war economic recession, barring 2008. But he could do so because the 1970s represent many things. For me, they represent the turning point, a turning point from the 1930s. So as you know, the US banking system went bankrupt. Prices were reset to zero in the early 1930s. And you know that debt to GDP back then was over 3 times GDP, 3x. And what it unleashed by an angry society was we were to split banks. The banks were no longer to be superheroes. The banks were no longer to be remunerated with these exorbitant privileges. The banks were to become civil servant utilities. And over the ensuing decades, that's what happened. Banks became dull reservoirs of deposits. And into the 1970s, debt to GDP fell from 3x to 1x. At 1x, you can raise interest rates. Sure, be a Texan and have swagger and kind of go, there's a new sheriff in town, I'm going to shake it up. But please do not try that at the end of a super cycle where debt is approaching 5 times GDP. That will create, we're in a mild depression, and you risk sending us over the edge into the abyss. And debt to GDP is rising everywhere because we've created fictional wealth. And fictional wealth is, I want to say, it is distinct from the wealth which is a function of raising consumption in the future. The wealth that's coming, the wealth that has been responsible for multiple expansions and asset prices being 7 times GDP is one of a reset in the price of money.
You said that there's been a lot of fictitious wealth created. Are you referring to sort of the speculative, no profit, no revenue companies that have gone public, like a oat milk company that gone public, $15 billion? Or is it the sort of lending for unproductive assets? And then also, when you say that it's been the price of money, is that sort of the cash flows have not grown? It's just that the discount rate has shrunk?
Mostly it's the latter. It's Apple trading at $3 trillion. Yeah. It's not trading at $3 trillion because there's been a permanent shift, elevation in demand for iPhones and their services from the app platform. It's trading at $3 trillion owing to liquidity preferences from terrified banks and other institutions that would rather accept zero or even negative, the certainty of zero or negative returns to the variability of positive or negative returns. And behind the surface, Bernanke, back in his pomp and his glory, went off on this story about a glut of savings. And this glut of savings is far more relevant than the Federal Reserve's quantitative easing, and is almost of the same magnitude. The mercantilist nations, principally China, but there are obviously others from the other Southeast Asian countries, as well as Germany at the core of Europe. They are very circumspect in terms of promoting domestic economic growth from their household consumer sector. And notoriously, consumption is only 40% of GDP in China versus the best part of 70% in our world. And please don't dare attribute that to some cultural quirk. The Chinese just save more. It is a function of explicit measures taken by the Chinese authorities to disincentivize people from consumption. They're terrified of it. They're terrified of it.
So what are those measures, Hugh? What are you talking about?
Well, I mean, you have a huge percentage of the population which are not given internal passports, which then just become this migrant workflow. They don't have access to healthcare provision and the like. Okay, so whatever they earn, they have to save a great deal because there's no state backing. These powerful regional governments, their tax levy on people is high. And so whatever you earn, obviously your take home from it is less. And then finally and crucially, the PBOC undertake a dirty peg vis-a-vis the US dollar. And the world that I grew up respecting, the world of market prices, the market prices would have pushed dollar renminbi. Today it's 6.75. It would have pushed them below 5 to 4.5, wherever, which is to say a stronger renminbi. Now, if that prevailed and I'm being paid in renminbi, you've just made me richer. You've made everything in the rest of the world cheaper, and I might want to buy it. And that's
right,
what the Chinese don't trust the decisions of individuals. Heck, they don't allow you to vote. Okay, so they're certainly not going to allow you to create a boom and a bust and entertain the notion of the disaster that we saw in Thailand et al. With the Asian tiger crisis at the end of the 90s. So owing to that, they buy US Treasury government bonds. That's why they buy
and
it.
Hugh, is that the mechanism by which they sterilize their currency? So they have way more dollars because they have a huge trade surplus with the U.S. and the rest of the world. So they have tons of dollars, and instead of in order so that the currency doesn't appreciate, they buy treasuries, and that's how that happens.
Absolutely. I mean, they could buy German bonds, but the Germans don't produce many. They could buy Russian bonds, but actually they don't have a proper contract law, and they're subject to kind of invading. Well, I know you could say the US is subject to invading countries, but like the Russians really kind of do it to a kind of Dadaist kind of level of absurdity. They could do it elsewhere, but the US Treasury market is the most liquid, because when they do it, two things, like you say, they are suppressing the market's desire to push the currency higher. And secondly, they're creating a rainy day fund for when the local banking system, the Chinese state does not control the banking system. I mean, it does and it doesn't. The Chinese banking system is controlled by the Eurodollar system. You need dollars, you need dollar collateral. You go on the matrix and you tap into that external world. It might be a bank in Bermuda, it might be a bank in Singapore, it might be a bank in Brussels. Most unlikely is it a bank in Beijing, and there are periods. China's been on the turn for 10 years, and the holdings of its treasuries have been going down because it's had to sell treasuries to put good collateral back into its banking system so that they can keep extending some notion of credit and therefore progression in Chinese GDP.
Hugh, in the Eurodollar system, what are the various loans that are being created? Is it purely financial, where it's, oh, I'm doing a repro transaction and I'm pledging some collateral and I'm buying it back the next day? Or is it commodity loans? Is it real estate loans? Because I hear the word Eurodollar system a lot, but you're an expert in this. You actually, one of the few people who actually knows the constituents. What sort of loans are we talking about? Is it?
It's all loans, Jack. It's a fully functioning banking system. You are in Singapore and you've got a trading company, and it needs to borrow dollars for whatever reason. You've got Singapore dollars, so you go into the matrix again, and you will do a collateral swap. And a whole chain will unleash itself. The system of taking deposits off people and then and being regulated by the Federal Reserve to how much you can do, etc. That's long gone. It was long gone in the 1920s saw the advent of checking accounts, and checking accounts, pieces of paper, like, hey, we've got Mrs. Smith. She's in Cincinnati. I understand she's from the San Francisco branch. She wants to buy $100 pair of shoes. Is that okay with you? And in fact, I don't know why I'm using my fingers to pretend I'm on a telephone, because this conversation would have been done by the telegraph. It'd be an SOS. It'd be Morse code. Revolutions in the facilitation of credit and moving increasingly away from government oversight to private sector decisions. Now, the problem with again, I would associate the Eurodollar system leaves its imprint. It's invisible, but when it touches Earth and when it touches our system, it leaves an indelible mark. What are the indelible marks of the last 5 decades? The inflation of the 1970s.
How so? How is that related to the Eurodollar system?
Because it furnishes dollar deposits outside the U.S. banking system. The explosion in oil prices from $3 to $10 in the early 1970s was partly an aggressive. Was entirely an aggressive policy by Arab nations and a reluctance to sell. Right? And so they didn't want to put their dollars onshore; they wanted their dollars offshore with banks in the rest of the world. Now, dollar deposits are dollar liabilities to a bank. Okay, and so you are incentivized to find dollar assets. What are assets? Lending. And so you have this mania, like, Jesus, like, oh, we've got all these dollar liabilities. Lend the money out, like, balance the book. Brazil, sovereign government, want to borrow money. Fantastic. Governments never default, really. They never default till they default, So, and also you had the Eurodollar system there were no quantitative restrictions on the leverage that you could apply. So the previous model outside Eurodollar was leverage limits. That was replaced by, as long as you have banking counterparties that are willing to respect and be the other side, have a party, like, go crazy, okay? But you're subject to the scrutiny of your peer group. So they went crazy, and inflation. Crazy meant they created a profound growth in dollar assets, i.e. they lent dollar money. And that furnished the inflation of the 1970s. Inflation is a monetary phenomenon. And then when all of those assets turned bad, principally loans to the South American economies, and again, because the Texan went, cha-ching, cha-ching, I'm raising interest rates. Like, what? Boom. The inflation of the 70s, and then the disinflation that then gets accorded to the central banks. And the profound silliness of the ninja loans in the early 2000s, no income, job, nothing. Hey, damn, take the money, please take the money. Because of that profound silliness, because they had this near-death experience. Yes, the Eurodollar system is functioning. Yes, it's making loans across the entire universe of credit, but it's doing so without that unbridled enthusiasm. And counterparties are constantly going, I'm not so sure about you, and changing terms. So once it was unbridled optimism, and today it's kind of fear and recrimination. And that is like a break, which again underpins my belief that these higher price increases will not become permanent price increases.
Given that view, Hugh, what do you make of the Federal Reserve's attempts to curb consumer price increases, both by doing quantitative tightening, reducing their balance sheet, as well as raising rates? Are any one of those things necessary, you think?
Federal Reserve is an irrelevance when it is relevant is doing self-harm. The greatest crimes of the Federal Reserve in the last decade have been these periodic moments of attempting to raise interest rates in a depression. Where are those periods? 2013. 2013 is like what? 5 years after the peak. The economy is like nominally 9% higher than it was over 5 years. Unemployment is high, like almost 8%. And they come out and they're like, oh, we're thinking about quantitative tightening and ultimately the economy looks strong. We're just telling you, honest folk, where we might be raising rates. Okay, that was wrong. 2015 or thereabouts, Janet Yellen, kind of had a good sense of things, was cautious. But, I feel like I've got to start the process of raising rates. Why? Tell me why, And then Jay came in and accentuated what Janet was doing kind of like softly. And he's like, yeah, I'm Paul Volcker, right? And we get a market meltdown. We've got Southeast Asia having a big problem, coughing up issues. Right. And the Fed has to back away from it again. And then, what they did with COVID, fine. The numbers we associate with quantitative easing, I think it's just token money. For sure, they've sprayed the igloos of the economy with like a very flammable liquid. These tokens are flammable. I mean, you are giving the private banking sector, you're saying, I'm looking over there. If you want to take all of this money and create loans, I'm okay with that, But the banking sector is like, no, not interested. And then perhaps the greatest sin is, Jay Powell was on daytime television in 2020 saying to people, we are printing money. And he was emphatically lying, and he knows that. And so the irony is now the higher prices, which I think can be explained elsewhere, as I've attempted to do earlier. Jay owns it. He owns it. He's the guy who's on TV saying, yeah. I mean, the Federal Reserve Act of the 1930s explicitly makes that illegal. A fine detail. I'm on daytime TV. We're printing money. Okay, well, you printed money, and now prices are rising unchecked. What are you going to do about it? And the president's saying, Jay, what the heck are you going to do? People, I'm unpopular because of you, right? And so, he's like, well, we'll raise rates. We'll keep raising rates. Yeah. He's trying to save his ass when I'd just rather he wasn't in the building. I'd just rather they disbanded the Federal Reserve. They are the regulator of the domestic US banking system. Like, the world has moved on.
What do you mean the world has moved on?
Flows of money are global. And it is not current. It's not savings accounts, which are liabilities for banks, which determine the propensity to make loans and therefore to create money. It is this whole system of a kind of dollar treasury collateral system, which allows you to kind of have unfettered credit growth if you choose, but only if you choose so. And again, in terms of doing harm, that Jay Powell cycle of rate hikes in 2018, we need energy. Like, Europe is exposing that. Remember, we're paying $600 per barrel of oil to heat homes in Europe. The US has plentiful sources of energy. Energy extraction is a wild, crazy business. It's complicated, it's expensive. It's typically financed with a high yield credit, which trades the secondary market. And Jay's rate hikes of 2018 did more to discourage investing in energy than perhaps on a par with the psychopathic environmental social governance policies of the Greens. He took secondary credit bonds from 97 on the dollar to like 27 to 17 on the dollar. He bankrupted the explorers. And we don't have credit people lining up to say, hey, find us oil. We're struggling. Like, US should be pumping oil just now. We're not, because they've all been told again, this is Ayn Rand. They've been saying, no. Wesley Mouch, we have regulations. We want you to deleverage. No, society wants you to damn find energy and get these prices sorted out. So I can't think of a time when the Fed did good.
What about 2020?
What about it? Okay,
so you don't think they did good?
They acted as a proper central bank. They were the lender of last resort. Principal thing there was, again, our Chinese friends had a margin call. They own treasuries to be able to have a source of dollar funding, which they can then repatriate and patch up the domestic banking system so that they remain standing. And the Federal Reserve honored that. It honored it, and it allowed them to sell down their treasuries. That was the right thing to do. But I tell you, the even more right thing to do moving forward is to tax sovereign holdings of treasuries. Because all it's leaving, first of all it does is it inflates asset prices. It corrupts the entrepreneurial spirit and makes everyone a speculator. It makes the cohort of the rich even richer and even less of a minority. And it makes everyone else a serf.
So how is that related to sovereign holding of treasuries? And it's also, is that foreign governments, foreign central banks, foreign anyone who's not in the U.S. at all?
It is the sovereign. Hey, listen, you've heard of SAFE. SAFE is the Treasury Management Department of the People's Bank of China. They're directed by the state. They own probably about between $3 and $4 trillion of treasury holdings. Okay, that's what I'm talking about. Tax them, right? Tax them.
So you want the dollar? You want the yuan to strengthen against the dollar?
I want the Chinese to trust their own citizens and to find endogenous growth, which is not building fast trains, which will never recoup the benefits in the future. Will never recoup the cost. I want them to enrich their consumers via a higher currency, higher pay, less taxes, but letting them off the leash and letting them be free. That's what I want. I want them to create demand for US manufacturers and for manufacturers in the rest of the world. We've given them contract law. We've given them liquidity. We've given them a bump. We've taken them from abject poverty to a rich nation. And it's time for them to respect us. Stop pegging their currency. Stop limiting their consumer household to get more mean reversion, to be more like us. And if they're not willing to do that, then tax them. Don't tax trade. Taxing trade is stupid. It's corrosive. It destroys global income. Tax the
it's inflationary. Taxing trade is inflationary.
And it's inflationary.
Yeah. Right.
Yeah.
Do you think that the Fed was behind the curve in 2021? Do you think it was slow to tighten monetary policy when inflation was picking up 3%, 4%, 5%, and the Fed was still at zero?
The Fed's irrelevant. The private sector was raising rates. The private sector was raising rates after the Fed intervened in March 2020. On its own accord, the private sector took 10-year from 0.45 to over 2%.
But Hugh, we probably disagree on this, but the explosion in the 2-year Treasury rate has a lot to do with the Fed, because the Fed has been hinting that it's been raising rates. Going to raise rates.
Yeah, at the very short durations of the Treasury market, if the Fed says and gives you the steer that they're going to do 75, 75, 75, then your 2 years going to reflect that. Your curve's going to say you're nuts. The inversion in the curve saying this is idiotic, but the absolute 2-year level is going to say, yeah, well, that's on you. So I think we agree, actually. Private sector determines everything. The wisdom is in the private sector. How many people are on the board of the Federal Reserve, right? How many people, like 12, 15? Okay, maybe they're supplied by 10,000 PhDs, okay? But, okay, what? Do smart people consistently and what is smart, but the academically PhD gifted students and institutions consistently make the right decision. Evidence suggests otherwise. 2003, the Bank of England, another central bank, staff full of really, really studious, hardworking, smart PhDs, decided that they would sell down the holdings of the bank's gold. Okay, for well-formed, academic, strong reasons. I would call that the conceit and the arrogance of well-formed PhD arguments. I was buying it. I was buying gold. What was my well-formed argument? I had a dream about the Wizard of Oz. Okay, so it is kind of crazy flow state people like me and less crazy other people every day being on risk, every day entering into contracts, taking commercial risk, every day risking our career and our reputation. That's what sets interest rates, not like 15, 60-year-old men and women meeting periodically to, like a Politburo. Who ever thought that that was a wise thing? And again, tell me the last time their rate, the ECB, another institution, lots of really smart academics. Those bozos raised interest rates in July 2008. You get the drift. Yes. They just raised rates 50 basis points. 50. Let me repeat. German households are paying $600 per barrel to heat their homes, and they just raised interest rates. Central banks will bring on, if unchecked and unfettered, will bring on social revolution. The trade war with China is class warfare, right? That's bad. That's gutted. That's gutted communities. It's created the opioid craze. People are depressed. World sucks unless you're like really, really rich. Okay? And then on top of it, you come in and you start raising their mortgage rate. Why? They're idiots. They're destroying the system. But,
Hugh, if there was no ECB and there was no Bundesbank, no Bank of Italy, it was all market rate, where do you think European rates would be? Where would the Italian 2-year rate be? And where would the German 2-year rate be? Higher or lower? Where it is? I think higher, right?
Long-term rates would be where long-term rates are just now, because long-term rates are not impacted by the shadow of the Federal Reserve. The Federal Reserve in its rate hiking only reaches out to a magnitude of about 2 years. So the curve inversions are telling you that the market's happy where it's got 10-year rates. Globally, is unhappy about the pretensions of the global central banking community. Jack, I am timed out. I've got a meeting with my notaire in town in about 15 minutes.
Nice. What does that word mean? Notaire?
Notaire is a kind of lawyer who's involved in real estate. Contracts. Okay. It's a contract lawyer. Yeah.
Cool. Well, Hugh, it's been a pleasure. People should check out your podcast, which is called Asset Capitalist, right?
Well, they should go looking for Hugh Hendry. Hugh Hendry's Substack, hughhendry.com. You can buy. They should be trying to find one of these hats. You don't necessarily need my name on it, but I want you to be a top cat. I want you to get your thinking cap on. I want you to get some asset capitalism. I want you to reject rigidity, linearity of thinking. With these hats are imbued with the spirit of occasionally being rock and roll and seeing round corners, and every now and again getting a glimpse of the future. These hats are stick it to the man material. You will find me in my episodic shaman interventions on Twitter, Hendry_Hugh, and then we put out a weekly podcast on a Friday on YouTube and on the wonderful Apple podcast platform. And yes, Asset Capitalist is where to find us. Thank you, Jack.
There is something that you need to be doing right now, and that is reading the Blockworks daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.